Friends, we will make a beginning with the new topic, assessment procedures. In fact, those students who completed their PE2 and came to the final, this is the second time that they are going through this particular topic, but definitely in the final, the way in which you approach this particular subject slightly differs from what you did at your earlier stage. Now, in the assessment procedures, first aspect of it is return of income. That is, assessee need to file the return of income. Of course, there are several sections under which we are going to study this particular return of income. Subsequent to the return of income, before the procedure for the assessment gets commenced, there is a very important section called as 142, which discusses about the inquiry before the assessment gets commenced. Then of course we got different types of assessments like regular assessment, best judgment assessment, reassessment, block assessment. Like that we have got the different assessments. So basically the whole lot of assessment procedures is being planned for about 6 hours of discussion with returns of income and then different assessment procedures and all the questions which were tested in the past examinations and the case laws. So to start with, because this topic, why final student always feel like, because as they start doing their articles, definitely these are the issues which they are going to get in their practical life also. So first, to start with, we will start with the voluntary return under section 139(1). See, I need to file my return of income first of all. What for? See, previous year. What is previous year? The year in which the assessee earned the income. In respect of that particular income, first he will make the self-assessment and he will, if required, the amount of the tax, if it is more than the TDS and the advance tax that he paid, then he will make the payment of the self-assessment tax. And then what he need to do? He need to give the information to the department stating that these are the different heads under which I got this income and this is what the tax that I paid. With this information should go, then only they can make the assessment. What do you mean by assessment? They are going to verify, check whatever that you stated in your statement is correct or not. For that, some procedure need to be laid down. That is, what is the prescribed form in which you need to give the particulars of your income to the department and within what due date you need to give that particular information, and along with that information, along with that particular return, what additional information is required to be given. So with respect to these things, we have to first look at voluntary return. Again friends, please do remember, there are two types of returns. One is voluntary return, second is return in pursuance of a notice issued by the department. That is, if you don't voluntarily file your return, department can well ask you to file the return by issuing a notice under section 142(1). Apart from this, if your case they want to take up for scrutiny, then you get 143(2). But please do remember, the very purpose of 143(2) and 142(1) are different. 142(1) is what? If you don't file your return, they will ask you to file a return. For this, they will issue a notice under section 142(1). Whereas, what is 143(2)? After you file your return of income, if they want to take up your case for a scrutiny assessment under 143(3), then a notice will be issued under section 143(2) is the point. Apart from that, if they want to take up your case for regular, that is your 147 assessment, that is a reassessment, then a notice will be issued under section 148 requiring you to again file your return of income. Like that, even when your case has gone for search, for block assessment also, you will get a notice, and in pursuance of that particular notice, you are going to file your return of income for that block period of 6 years. So basic understanding that we need to have at this juncture is, there are two types of returns. One is a voluntary return and another is a return in pursuance of a notice. Now in this voluntary returns under section 139, the first thing that we are looking at is what? Voluntary return to be filed before the due date. This is being discussed under section 139(1). Write down. Voluntary return under section 139(1). Voluntary return under section 139(1). First look at what is voluntary return under section 139(1). What it says, that is, every person, let us suppose it is a company or a firm, it need to file a return before the due dates. Other than company or a firm, when the requirement to file a return comes, that is, in case if they got income which exceeds the maximum amount up to which income is not chargeable to tax. That means if they got taxable income, necessarily they need to file their income tax return under section 139(1). See, if you look at the provision clearly, this requirement to file a return only when you got income is only available for SSEs other than company and firm. So that means what? Indirectly it is clearly stated that in case of a company or a partnership firm, whether they got income or no income which is chargeable to tax, that means even if they got a loss, it is mandatory for the company SSEs and for the partnership firms to file the income tax return. Yes. Now, what are the due dates for filing the income tax return? There are two due dates. One is 30th September of the assessment year. Second is the 31st July of the assessment year. Now the point of interest is, who are the assessees who required to file their income tax return up to 30th September? For that, what the law says, a company can file its return up to 30th September of the relevant assessment year. Second, any person who need to get their accounts audited under the income tax law. Yes, any assessee who require to get their accounts audited under the income tax law, that means under section 44AB, in case if your case is subjected to the tax audit under section 44AB, our third situation is what? Third situation is what? Let us suppose you are a working partner of a partnership firm whose accounts need to be tax audited, then you are also permitted to file your income tax return up to 30th September of the relevant assessment year. Here one more point that should go into your mind is, there is a concept called as a presumptive tax. There is a concept called as a presumptive tax. That is, certain assessees are subjected to the presumptive tax. And in case if covered by the presumptive tax provisions, if they don't want to offer such presumptive income and presumptive tax, that is, in that situation what will happen, friends? Those who don't offer that presumptive income, what is the consequential effects? They need to maintain the books of accounts and they need to necessarily get their accounts audited. So those to whom the presumptive income scheme is applicable, if they don't accept for such presumptive income, necessarily they have to maintain their books of accounts and get them audited. For them also this particular due date of 30th September is applicable. Now friends, other than this, in any situation what should happen? That is, very well the assessee should file their returns before 31st July of the relevant assessment year. Now the point of interest here is, what is the consequence if I don't file my return before the due dates? Of course, there are many of it which we are going to discuss at the relevant places also, but at this juncture try to understand generally. Let us suppose you are claiming an exemption or deduction, exemption under 10A, 10B, or deductions under section 80, IB, IC, ID, IDE. Then unless you file the return before the due date, whatever the benefit under the respective section, that will not be allowed in your case. That is the reason why, where you are taking some benefit under the income tax law, like let us suppose you are incurring the loss. Such a loss will get the eligibility to be carried forward, to be set off at a future date. Necessarily, loss return must be filed before the due dates. So, these are all the possible consequences. Apart from that, immediate consequence is what, friends? That is, you may be liable for a penalty Under 271F, if you don't file your income tax return within the due date, they can very well levy penalty on you under section 271F of rupees 5,000. Of course, friends, sir, I know that many people are not filing their returns before the due date, and I know that there is a concept called as a belated return which can be filed belatedly up to 1 year from the end of the relevant assessment year or before the assessment gets completed. When a belated return chance is there, why penalty is being levied? Friends, try to understand, belatedly you can file a return. That does not mean that we are giving you a right to file the return belatedly. There are a number of disadvantages for belated return, one of which is you are being exposed to a penalty under section 271F. Second, loss being not allowed to be carried forward. Third being, a belated return cannot be revised. You can't file a revised return once your original return happens to be a belated return. These are all the possible consequences. Of course, penalty, is it automatic? No. That is, if some reasonable cause is shown why the return is not filed before the due date, very well such a penalty can be waived off. No penalty will be imposable is a point. So this is all about voluntary return under section 139(1). Note down the points. Note down the points. First, point number 1. Company SSEs and partnership firms are required to furnish the return of income, under section 139(1), irrespective of the fact whether they have income oblique loss or loss, other way around. Next point. Any SSE other than company SSE and partnership firms, need to file the return under section 139(1), only when they are having taxable income. Of course, friends, every rule comes with an exception. इसका ये मतलब नहीं 139(1) he is giving a free hand to the SSEs other than company SSEs and partnership firms not to file the return before the due date even when they got the loss. Because in 139.3 when we discuss, we say if you don't file your income tax return before the due date when you are having a loss, then you will be losing your right to carry forward such loss. Of course, it's not 139.3 says, it is section 80 says. There that point I will make you to write. Next point, due date. Side heading, due date. Point number A. In the following cases, due date will be 30th September of the assessment year, 30th September of the relevant assessment year. That is A, company, B, a person other than company whose accounts are required to be audited under income tax law or under any other law, Then friends, third one is working partner of a partnership firm, in case where partnership firm's accounts are required to be audited under income tax law or under income tax law or under any other law Then friends, write down next. Due date in case of any other assessees. Due date in case of any other assessees other than the above will be 31st July of the relevant assessment year. See, let us suppose there is a working partner. He is getting a fixed remuneration. See, what is the objective? First of all, in allowing a working partner of a firm whose accounts are to be audited under the income tax law or under any other law. Usually, remuneration will be based on the profits, let us suppose. Then unless profits are correctly ascertained, it may not be possible to quantify the remuneration exactly. That is the whole lot of objective. But still please remember, these types of objectives are not being stated anywhere in the law. It is only our understanding of it. Now somebody raised a question. See, only when the remuneration has got a linking to the profits, we can understand partner of a partnership firm whose accounts are to get tax audited can file the return up to 30th September. Let us suppose if a partner is there, he is a working partner and he is getting a fixed remuneration from the firm, then he should file the return by 31st July. Is it the case? Definitely not. See, in my firm, I can fix up a fixed remuneration and a firm also may be paying that particular remuneration to me. But ultimately, all what fixed remuneration that they paid may not be allowed under the income tax law. Because under the income tax law, in firm's case, what is the remuneration to be allowed? We all studied in the profits and gains from business and profession. What is the allowable amount of a remuneration? Disallowed portion, what it will happen, friends? On that, who is paying the tax? Firm is paying the tax, and it will get the nature of the profits only, and to that extent it will not be taxed in the hands of the partner. So whether it is a fixed remuneration or otherwise, please do remember, if you are a working partner of a partnership firm whose accounts are to be audited, then you can very well file your return up to the due date of what? 30th September is the point to be well remembered. Then one more important point is, companies are there. Let us suppose if it is a newly incorporated company or a firm and it has not yet commenced its business, still please remember it need to file the return. Even if the business is not commenced, it need to file the return. Similarly, a foreign company or a foreign firm operating in India and having no incomes in India, still it need to file the return. A company or a firm whose income got exempted under the income tax law, even if the whole income is exempted, still it need to file its income tax return. Similarly, a company is in the process of setting up of its business, whether income is there or not, it need to file its income tax return. Even if it is a defunct company, even if it is a defunct company which has closed all its activities, still it need to file its income tax return. So what is the point that we are driving here is, friends, a company or the firm, whether it has got income or no income, mandatorily required to file its income tax return. Then electronic filing of income tax return. Now it is mandatory for the company SSEs, corporate SSEs, to file income tax return. What is it? Electronically. And please do remember, if they are partnership firms, then if they are liable for tax audits, necessarily what should happen, friends? Return need to be filed electronically. E-filing is made compulsory for the company SSEs and those firms whose accounts need to get tax audited under section 44AB. Write down: e-filing of return of income. E-filing of income tax return. It is mandatory. It is mandatory for the corporate SSEs, and the firms which are liable to the tax audit, which are liable to the tax audits, to file a return electronically. Once you are a company SSE, it's mandatory. If you are a firm, then what will happen, friends? Then what will happen? Only in case if your accounts need to be tax audited under section 44AB, it is mandatory for you to file the return in the e-filing format. Then friends, one more important point, like that is, in case if you are claiming some deductions under section 80 IC ID IE, then unless you file your income tax return before the due date, you will not be allowed to get that particular deductions. Write down. Who said so? It is not 139(1) says, 80 AC says. Write down. Section 80 AC provides. Section 80 AC provides that in computing the total income, in computing the total income of an SSE, of the previous year relevant to any assessment year, relevant to any assessment year, comma, any deduction is admissible, any deduction is admissible under section 80 IA, 80 IA or 80 IAB, comma, 80 IB, comma, 80 IC, comma, 80 ID, comma, 80 IE. No such deduction, comma, no such deduction shall be allowed to him, shall be allowed to him unless he furnishes return of his income, for such assessment year, on or before the due date specified, under subsection 1 of section 139(1), under subsection 1 of section 139. And one more point, deductions brackets exemption under section 10A/10B shall not be available if the return of income is not filed within the due date, allowed under section 139(1). Allowed under section 139(1). Then few more important aspects will be, write down next point, penalty under section 271(f). If a person who is required to file the return, under section 139(1), fails to file the return before the end of relevant assessment year, the assessing officer shall direct that person shall pay by way of penalty a sum of rupees 5,000. Of course, next point will say that this penalty need not be levied in case for good reasons there is a failure. Write down. No penalty is imposable. On the assessee if he proves that there was reasonable cause for failure to file the return. Under which section it is stated, friends? Keep hyphen and put section 273B says so. Section 273B says so. Then friends, as far as this particular item is concerned, you need not write. 139(1)(a) general knowledge, that is bulk filing of the returns. 139(1)(a), bulk filing of returns on a computer readable media by certain salaried taxpayers. See, it's more for convenience. It is stated that if there is a very big company, then so many employees will be there, then they can always file their return to the employer. Employer will keep all these returns and send that particular CD to the income tax department. Of course, if you go in detail, try to understand, income tax law states to which type of employers, the employees, this particular facility is available. All the details we are not discussing here. Again, if an employee has got so many incomes other than salary and house property income, so many other incomes, it's not mandatory that he has to go to the employer and file the return. He can very well file the return with the department directly. But Once the scheme is applicable, if he files his return with the employer, that is enough. Before the due date, if he files the return with the employer, subsequently employer will make electronic data entry of all these returns and prepare a CD and file with the income tax department as a point. Then friends, other than this filing through employer, we have 139(1)(b), which says electronic filing of return of income. Of course, earlier we have discussed it is mandatory for the company SSEs and the partnership firms whose accounts are required to be audited under 44AB to mandatorily file the return electronically. For other people also that facility of e-filing is there, but it's only an optional kind of a thing. For other SSEs, they can also file the return electronically, but it is optional. This is being discussed in 139(1)(b). Then friends, we move to the next important section from the examination point of view, that is loss return under 139(3), read with section 80. Write down loss return under section 139(3). Loss return under section 139(3). Friends, try to understand what 139(3) says. 139(3) says, if a particular SSE, irrespective of the fact whether they are company SSEs or partnership firms or individuals or HUFs, whoever it may be, if they are having a loss, then they need to file that particular loss return before the due date, which is specified under section 139(1). Now, please do remember, who said loss will not be allowed to be carried forward to be set off in a future year unless you file your income tax return before the due date? It is a section 80 says that the losses which are there given in section 72, 73, 74, 74A, these cannot be carried forward. While framing that particular section 80, they are not including there 71B. 71B deals with what? Carry forward of the loss under the head income from house property. So, in respect of two losses, that is loss from house property and unabsorbed depreciation, even if you don't file your loss return within the due date, still you can carry forward that particular loss. See, what is the whole objective here? Try to understand. What is the whole objective here? See, if I say income, I need to pay the tax. If I say loss, I don't need to pay the tax. Moreover, I get the eligibility to set off this particular loss against my other incomes. See, department will be going through loss return more meticulously. Why? On one hand, they are losing this year tax. On the other hand, this loss the SSE can very well set off against the future year income and can very well reduce the tax burden. दो बार उसको बेनिफिट मिल रहा, एक यहां पे टैक्स नहीं पे कर रहा, दूसरा उन्होंने ये लॉस लेके नेक्स्ट ईयर इनकम को कम कर देते. तो necessarily they have to check, is it what the SSE correctly stating that he got the loss, really whether he got the loss, they have to check it or not. So unless you file your return of income, how they will be able to check? That is the reason why in the income tax law they said unless you file your loss return, you will not get the eligibility to carry forward that particular loss. One more interesting point you have to remember, friends. Just because you have filed your loss return, is it automatic that that particular loss will be eligible to be carried forward? Please do remember, feel happy only when your assessment got completed and they have accepted what the loss that you filed through your return of income. Then that becomes a pakka loss which will get a pakka eligibility to be set off. Otherwise also, even if my loss assessment is not completed, simply I filed my return, I am carrying forward the same to set off. But at a subsequent date, if such a loss return is taken up for scrutiny or reassessments, and if it is found that that loss is not a correct loss, what will happen? Even the subsequent returns which you filed and subsequent assessments which has happened, again they also require to be revised. Those assessments also will get the problem. So खुशी किस बात में होना? खुशी जब होना जब मेरा लॉस को उन्होंने एसर्टेन करके असेसमेंट कंप्लीट करे सो है तो हमको खुशी है. तब तक क्या है? Yes, I got the eligibility to carry forward and set off. If I don't file the loss return, then I am losing permanently my right to carry forward such loss. Then interesting aspects. Let us suppose for the financial year 2008 and 9 I got the loss and I filed my loss return within the due date for that particular year. In the next year also I got the loss, but I failed to file my loss return within the due date. Then is it that I am going to lose my right to carry forward the loss of earlier year where I filed my loss return within the due date? No. Only such loss in respect of which you fail to file your loss return within the due date, that only will be losing its right. But earlier losses for which properly you file your loss returns, they are well eligible to be carried forward to be set off is the point. So make note of all these important points. That is, if a person has sustained the loss, if a person has sustained the loss under the head profits and gains from business, under the head profits and gains from business, or under the head capital gains, or under the head capital gains. Of course, friends, there will be no loss under the head salaries, and loss under the head income from other sources will not be allowed to be carried forward. Only loss under the head income from other sources that will be allowed to be carried forward is what? Loss from the activity of maintaining the horse. Only that loss is eligible to be carried forward. Otherwise, no other loss under the head income from other sources is allowed to be carried forward to the future years. So write down. And claims that such laws should be carried forward, and claims that such laws should be carried forward under section 72, or section 73, or section 74, or section 74A, comma, then he may require, then he may furnish a return of loss, within the time prescribed, under section 139(1). Next, friends, write down section 80. That is, notwithstanding anything contained in chapter 6, comma, the loss which has not been determined, in pursuance of a return filed in accordance with the provisions of section 139(3), comma, shall not be allowed to be carried forward and set off, under section 72 or 73 or 74 or 74A. Now try to understand the point. Rule is important, exception is much more important. That is, write down loss under the head house property, comma, unabsorbed depreciation, can well be carried forward even if a return is filed after the due date. Then, friends, point here is when we sit in the exam, all these doubts will come. Let us suppose for the financial year 2009 and 10, Harita is having income under the head profits and gains from business and profession, and she is having a loss under the head income from house property, right? What is the income from profits and gains from business and profession? Let us suppose 5 lakhs. What is the loss under the head income from house property? Let us suppose 3 lakhs. She failed to file her return within the due date. There is no carry forward loss, because 5 lakhs is the income from the profits and gains from business and profession, 3 lakhs is the loss from the, income from house property. If she don't file her return of income before the due date, will she lose her right to set off? Because there are two things here, friends. One is a set off and another is carry forward to be set off. What the restrictions which we are having here are all what? Are with respect to the losses to be carried forward to be set off. So as such, in the same year you have got income from one head and a loss from the other head, then nothing prevents, even if you don't file your return before the due date, you can very well set off. Not only since it is a loss from house property, vice versa case also. You have got income from house property, loss from the profits and gains from business and profession. For the same, in that particular year to be set off, whether you are filing your return before the due date or not, you can very well set off. That point you just make note. Losses can be set off. Losses can be set off in the same year, even if return of income, is not furnished within the due date, due date. Then friends, one more question from this particular area is, SSC failed to file the return, loss return within the due date under section 139(1), but in pursuance of a notice under section 142(1), he filed the return within the date specified. Can he carry forward the loss? The answer is no. He can't carry forward. Because what is most important is loss to be filed, loss return to be filed before the due date. What is specified under section 139(1) is a point. So last point, write down. Loss cannot be carried forward if the return is filed in pursuance of notice issued under section 142(1) and after the due date specified under section 139(1).